Principal Global Investors now joins us from Hong Kong. Binay, good afternoon. Now, the market for last 3 or 4 months has been all about individual stocks. We've seen big moves in mid caps, while Nifty has remained flat. Do you think this kind of trend will continue?
Yeah, one of the themes we've been looking at is the move away from beta plays to more alpha opportunities. And that is partly being driven by the fact that the growth environment is undergoing a change. The domestic financial conditions are changing. And that is going to bring a set of opportunities for investors by looking at companies which benefit from this change. At the same time, there are enough macro headwinds in the form of lower commodity prices, changes in the US interest rate policy, which are going to impact the larger cap, the global export companies. So our sense is you will see more and more of stock selection opportunities in the Indian space in the coming 12 to 24 months.
Okay, within the mid-cap space, we've seen a big rally in a lot of stocks like paint stocks, tire stocks, even oil marketing companies because of the lower crude prices aiding margins, but we still haven't seen top-line growth. Is this trade now getting overextended?
It might be. Clearly, if you look at Indian companies till last year, we are seeing a margin compression because input costs were rising, commodity prices were up. And we're getting that benefit now over the past 3 to 6 months. It's beginning to flow into bottom lines. And I think the markets will give benefit to such companies for a few quarters. And then if the top line growth doesn't come through, then you will see a disappointment in those companies. But at this stage, there is a noticeable fundamental improvement. It'll have to be followed through with top line improvement as well. And that is where the macro theme about India's growth dynamics changing for the better comes in. So the expectation is that while so far this year the top line growth is very bad actually, you will get better top line growth going into FY16 and FY17.
Okay, let me get to my comfort zone, Binay. What about PSU banks? We have seen quite a bit of rally there. Is that sustainable or would you avoid that sector?
Still favor the private sector banks which have been successful in growing balance sheets at 20-25% per annum without too much of NPL stress. The rally in PSU banks seems more like a correction from technical oversold positions given the announcements about capital infusion by the government. We fundamentally need to see improvement at the operating level as well as improvement in terms of future NPL accretion before you get bullish on these banks from a long-term standpoint.
Okay, Binay, we are at the fag end of the earnings season. What's your call on the overall earnings cycle? This quarter wasn't great, but wasn't as bad as well.
It seems to us that we are at the bottom end of the trough in earnings. But again, there's a big macro assumption behind that, which is that growth will pick up going into 2016 and 2017. There are signs, as I said earlier, that margins are recovering. But of course, top line growth, which has been very low, has to pick up in a much more substantial manner for the valuations to be justified going forward.
Okay, that's the macro. But is there any sectoral theme that you're bullish on?
Well, our portfolios, the portfolio managers and the analysts, they look for fundamental factors in deciding which stocks are to be bought for the equity portfolios. And they use a combination of valuations, fundamentals, and earnings momentum factors. If you look at the Indian space, clearly domestic consumption is something which I think will continue to do well. India's biggest long-term story is demographic and the emergence of a large middle class, which was burdened by high inflation in the past. And now with the inflation framework that RBI and the Ministry of Finance has agreed on, the general feeling is that inflation will not be such an impediment going forward. Also linked to structural improvements in the economy. If they're able to de-bottleneck the supply side, then inflation structurally will go down. So which will allow the middle class to do very well. So all these sectors and stocks linked to middle class consumption should do well. At the same time, riding on a recovery and global recovery, you probably see IT still doing well because of the fact that spending in Europe, which was pretty low so far, will pick up. The US is expected to grow at a stronger pace over the next 6 to 12 months. That should do well as well. There are champions in the pharmaceutical sectors which have always done well in India. And the pharma opportunity is massive. If you look at the trends towards more health awareness, at the same time, a more corrupt environment, the need for pharma, not just for medical purposes, but also for lifestyle purposes will go up dramatically. So some of these sectors, and then you always get opportunities, valuation related, in the more cyclical sectors which will come out. So there is no particular factor which we look at when we buy stocks, but a combination of these.
Okay, so you spoke about three themes, so let's address some of them. Consumption looks good, but we've seen a big surge in valuations in stocks like Britannia, Bata, even some of the others. HUL also saw a bit of a surge. Is the risk reward still favorable?
Yeah, they have to keep delivering on growth. Take, for example, what happened with, say, ITC, where there was a bit of a disappointment growth linked to the taxation structure and the stock got sold off. It's underperformed. So with stocks which are trading at 30, 35 or 40 times 1 or 2 year forward values, growth has to come. Otherwise, they stand at risk of correction. The other way to look at the consumption story could be to look at more cyclical domestic consumption stocks, which are trading much cheaper than these longer term stable consumption stocks. So depending upon the kind of the valuations and the opportunities and the view on the economy, one could look to play that as well.
Okay, the other sector which has delivered pharma, but we have seen some accidents like Sun Pharma, while Dr. Reddy's has made new highs consistently. How do you play this sector when there is so much stock-specific uncertainty?
I would agree with you that it's got a lot to do with stock selection in that space because of the risks that are posed by regulatory aspects. So you have to be careful about the stocks you buy. But again, even like in the case of Sun Pharma, if you look at the stock was a winner for several years. It's delivered one of the best returns in the Indian stock market for a long time. And there's been some disappointment recently. But if they can get their act in order, there's no doubt that they have the business acumen to grow the business. So it's a matter of, I guess, getting their act together now for them to resume their trajectory of growth.
Okay, so what about the pharma space, or rather the auto space? Because we've seen Tata Motors go through a brutal correction, while Maruti has been hitting new high practically every day. Hero, Bajaj, they've also been quite volatile. Anything that you like here?
Well, I'm not myself involved in stock selection for these portfolios, but all I can say is that such massive divergence in returns between large cap stocks in a particular economy is great for stock selection. So assuming that you have the right tools to make the calls on these stocks, then you can make a lot of money for investors. And hopefully we have the team on the ground which is there to make the right calls on these matters. But I completely agree that return divergence has been massive in the automobile sector. Not just now, even like 2 or 3 years back, the return divergence was great. I remember there's a time when Mahindra used to be the favorite in the market, but then it seems to have kind of fallen off. Today, Maruti is very good, and some people are even questioning if, the stock value of Suzuki, which owns Maruti, is actually the rest of the business is valued negatively as compared to the Indian operations or not. So, but again, think back and talk about the consumption theme, then they've done everything right. They had a challenging environment. The weaker yen is supporting their business in terms of expanding their margins considerably. But they've done things very well. I mean, a company which has had such a massive market shares continue to maintain that despite competition from foreign brands. So you've got to give them credit for it.
Okay. The other story that has played out in favor of India has been crude, below $50. What would it mean for further gains in oil marketing companies? And more importantly, can it lead to a further macro re-rating of India?
Actually, I'll address the second one first before going to the first one, which is macro re-rating for India. That's already happened. Historically, till maybe a year back, India was very correlated with risk globally. So India would do well when oil prices were going up, when flows were coming into emerging markets, when everything was great for global growth. But in the last 1 year, you've seen this massive derating, as in delinkage between the dynamics which govern Indian stock markets and what's happening in the global risk on risk off space. So you've had a situation where oil prices are down, Indian markets are doing well, dollar is up, the Indian currency has behaved very well as compared to the other emerging market currencies in Asia as well as Latin America or Eastern Europe. So people are already assigning a lot of value to this benefit that India gets being one of the largest net importers of energy because of lower crude prices. And it's great, there is some trade-off here in the sense there are some upstream companies on the Indian market which suffer because of lower crude prices. But by and large, the benefits are hugely positive. So if oil stays at $50 or 55 or 60 bucks for the next 3 or 4 years, it's going to be very positive for India. It will probably allow India to move on to the trajectory of growth, which is 8 to 8.5%, with a substantial share of profits going to the corporate sector, because of the fact that with crude staying in that range, RBI will be able to cut rates further. It will create a positive consumption cycle. At the same time, it will give time for the stressed borrowers to repair their balance sheets. So Indian story could gain further strength if crude remains where it is. And the first question about marketing oil companies versus producers, that one remains a play as long as crude prices remain where they are, or as long as the government keeps following its policy of the current pricing framework for oil products in the country. Now, we've seen in the past that there is a tendency among governments to shift policies if the crude prices go up. Hopefully they will not do that, and therefore they will not penalize the marketing companies unduly, in which case these companies have very good businesses. They have a near perfect scenario for demand. It's a country which has short production in these products, and if they can be assured of margins for getting the product from the producers and giving it to the retailers, they will always make money.
Okay, Binay, so final question then. At index levels, do you see Nifty catching up with its peers in the second half of this year, or what's left of this year, or first half of next year, considering that on an index level, we have been a bit of an underperformer this year?
Well, we've underperformed a little bit this year as compared to some markets, but we are not so bad, given the fact that if you adjust for the currency strength that India has had, in dollar terms for global investors, India has not done poorly at all. Just to give you an example, at the end of last month, I think Indian equity markets were up about 2 to 3% at the index level. But if you look at the edge share market in Hong Kong, that was down about 7 to 8%. You look at markets in Russia and Brazil, they're also not doing so well. So India has not really underperformed, and some of it is actually just consolidation after a very strong performance last year, right? So we had like some disappointments at the beginning of the year in terms of the pace of the reform process, in terms of disappointments on the monetary policy. Frankly, I never expected RBI to cut rates, but you've had some disappointments on that count. But and that is given, and India was a significant overweight position in global emerging portfolios. So that is understandable. But by and large, if you look at the longer-term structural story for India, and if the assumed top line and bottom line growth does come through, then India should do pretty well at an index level as well as compared to its Asian and emerging peers.
All right, Binay, thanks a lot for your time today. And yes, that point is taken. In dollar terms, not the worst of performers our market. And keep in mind, last year was a good year for us. We'll take a break on that.